Everyone dreams of riding the bull market all the way up. But the real question is, when do you get off? As prices soar, fear and greed kick in. You start wondering, is this the top? Should I jump out? But what if it keeps going up? Will everyone make more money than me? And just when things look unstoppable, the market pulls the rug, leaving most traders holding the bag. The truth is, almost nobody sells the exact top, not even the pros. But history shows us that bull runs follow patterns, and there are clear signs when the market is nearing its peak. My name is Danilo, and in this video, I'll break down everything you need to know about spotting the top of this bull market. No complicated technical indicators, just real-world trends, market sentiment, and how whales and institutions behave when things start overheating. By the end of this video, you'll know exactly what to watch for so you can take profits before it's too late. So, make sure to subscribe and hit that bell icon so you don't miss future updates. Now, let's get into it. Crypto bull markets may feel unstoppable, but history tells us that they always follow a cycle. Bitcoin leads, altcoins follow, and eventually, the market overheats before a crash. This cycle is largely driven by Bitcoin's halving, which happens every 4 years. When new Bitcoin supply is reduced, demand kicks in, triggering an uptrend. Every cycle, Bitcoin peaks first, Ethereum follows, and then altcoins experience their final euphoric run before the market collapses. Now, we've seen this in 2013, 2017, and 2021, and every time, the warning signs were the same. Parabolic price action, retail FOMO, and altcoins massively outperforming Bitcoin in a short period. Each time, late retail money floods in, convinced that they're getting in early, but in reality, they're buying from smart money that's already exiting. When media outlets and celebrities are hyping up crypto to the masses, it's usually a sign that the cycle is nearing its peak. The market top isn't a single moment, it's a process, and the smartest investors are the ones who recognize the shift before it's too late. But this time, things might not follow the same script. Unlike previous cycles, we now have Bitcoin and Ethereum ETFs, institutions buying in earlier than ever, and a regulatory environment that's more pro-crypto than in past bull runs. Could this extend the cycle, or will it just lead to a bigger blow-off top? The biggest change is Bitcoin and Ethereum spot ETFs. In past cycles, institutions stayed out on the sidelines or only had indirect exposure through grayscale trusts and publicly traded companies holding Bitcoin. Now, for the first time, we have billions of dollars flowing into ETFs from hedge funds, asset managers, and traditional finance investors. This isn't retail hype. It's steady, persistent, long-term capital. The big question is whether this will lead to a longer, more sustainable run or just a bigger crash when institutions eventually unload. Another shift is the regulatory landscape. In previous cycles, governments were either silent or actively working against crypto adoption. This time, we have the most crypto-friendly US administration in history, alongside global regions like Hong Kong and the Middle East integrating crypto into their financial systems. Instead of fearing a crackdown, institutions could see crypto as a regulated asset class, which could mean a much larger wave of capital flowing in over time. Then there's China. For years, China has been a wild card in the crypto space, banning trading but still allowing underground adoption. Now, there are signs that China may be softening its stance through Hong Kong's regulatory framework. If China opens its markets to crypto investment, even partially, it could drive an unprecedented level of demand, especially if supply remains constrained. With all these factors at play, this cycle is shaping up to be different from anything we've seen before. The key question is whether these new dynamics will extend the bull market or just fuel an even more dramatic crash. Even though this bull run has unique factors at play, one thing hasn't changed. Markets don't go up forever. At some point, liquidity dries up, hype peaks, and smart money starts selling to latecomers who think the rally will last forever. While no one can call the exact top in real time, history shows us that certain warning signs consistently appear before major market reversals. One of the biggest red flags is massive retail FOMO. Every cycle, there comes a point where crypto is everywhere, on mainstream news, in celebrity endorsements, and being pushed by influencers who weren't even talking about it before. When people who ignored crypto for years suddenly start buying, convinced that they're early, they're usually late. In 2021, one of the clearest signs that the top was in came after crypto apps dominated the App Store rankings. Coinbase, Binance, and even meme coin wallets were the most downloaded apps in the world, at the same time that altcoins were reaching all-time highs. But by the time everyone was downloading trading apps, smart money had already started exiting. But here's where things get interesting. Each cycle, the top looks different. In this bull run, we've already seen crypto apps surge back into top app store rankings, but the cycle doesn't seem to be over anytime soon. This suggests that past warning signs won't always work in the same way. If app store trends aren't the leading indicator this time, what is? That's why it's important to look at the combination of factors rather than assuming one pattern will repeat exactly the same way. Another major signal is Bitcoin dominance crashing while altcoins go parabolic. At the start of a bull run, Bitcoin leads, but towards the top, altcoins start outperforming aggressively. Meme coins and random low-cap projects with no fundamentals begin doing 100x overnight, driven purely by speculation. Historically, once Bitcoin dominance drops to new lows, it has marked the final altcoin season before a collapse. Institutional outflows are another major red flag. Unlike past cycles where retail dominated the market, institutions now control a massive portion of liquidity. ETFs have driven billions in demand, but what happens when these funds start taking profits? If we see a spike in ETF outflows, hedge funds unwinding positions, or large Bitcoin and Ethereum transactions moving onto exchanges, it could signal that institutional players are cashing out while retail buyers are still chasing the top. Rather than government crackdowns, unexpected regulatory shifts or policy changes could also trigger the end of the cycle. While the US is currently the most crypto-friendly it has ever been, global regulations in places like Europe or Asia could impact sentiment and liquidity. If major financial institutions suddenly pull back on crypto exposure due to changing policies or risk management concerns, it could be an early sign that the cycle is losing momentum. None of these signs alone guarantee an immediate crash, but when they start stacking up together, it's a signal to be cautious. The key is recognizing when euphoria has reached unsustainable levels and making sure you have a plan in place before the market shifts. Knowing a market top is coming is one thing. Navigating it is where most traders fail. The biggest mistake people make is waiting too long, convinced the market will keep going up forever. By the time the crash starts, it's usually too late to exit at a good price. That's why the smartest strategy isn't trying to sell the exact top, but scaling out gradually. Market tops are a process, not a single moment, and different assets peak at different times. Bitcoin usually tops first, Ethereum follows after, and altcoins have their final run before everything reverses. Instead of holding everything until the end, taking profits at key levels ensures you don't get trapped when sentiment shifts. A simple way to do this is by setting profit-taking targets in advance. If you're holding a portfolio of Bitcoin, Ethereum, and select altcoins, you can plan to sell a percentage of each as the market reaches new highs. For example, you might take 10% off the table when Bitcoin nears all-time highs, another 15% when altcoins go parabolic, and another chunk when meme coins start doing 100x overnight. This way, even if you don't sell the exact top, you're still locking in gains along the way. Another crucial part of protecting yourself is avoiding liquidity traps. When market tops happen, panic selling kicks in fast, and illiquid assets crash the hardest. This is why holding high liquidity assets like Bitcoin, Ethereum, and top altcoins is much safer in the later stages of a bull run. If most of your portfolio is in low cap altcoins or meme coins, those are the first to collapse when the hype dies down. Some traders also rotate profits into stable coins or other assets instead of going fully to cash. Instead of selling everything into fiat, you could park some gains into stable coins and earn yield in DeFi, reinvest in Bitcoin and Ethereum after corrections, or diversify into real-world assets like stocks or real estate. This helps protect wealth without completely leaving the market. At the end of the day, the key to surviving the end of a bull run is having a plan. Instead of reacting emotionally when things get volatile, set your targets, take profits along the way, and don't get greedy. Most people only realize the top is in after they've already lost their gains. Don't be one of them. Nobody knows exactly where the top is in until after it happens. The market is designed to make you doubt yourself. If you sell too early, you feel like you missed out. If you hold on for too long, you watch your profits disappear. The reality is, most people don't time it perfectly, and that's okay. What matters is recognizing when euphoria is at unsustainable levels and managing risk accordingly. Every past cycle has ended the same way. Bitcoin peaks, altcoins explode, and then everything collapses. But this time, with ETFs, institutional money, and a more pro-crypto regulatory landscape, we could see a longer, more drawn-out cycle instead of a sudden crash. Now, that doesn't mean it won't end. It just means it might play out differently. The smartest investors aren't the ones who hold until the last second, they're the ones who secure their gains while there's still demand. Instead of trying to time the absolute top, scaling out, staying disciplined, and taking profits when things get euphoric is the best approach. And remember, crypto isn't going anywhere. If history repeats, there will be another cycle after this one, and the people who survive will be the ones who took profits, stayed patient, and reinvested at the right time. If you found this video helpful, make sure to like, subscribe, and hit the bell icon so you don't miss my next update. And let me know in the comments, do you think this bull run will last longer than previous ones, or is history about to repeat? Thanks for watching, and I'll see you in the next one.